Okay, welcome everybody to the second quarter webinar for Holmquist and Gardiner. Super excited to do a broker roundtable. We've had a lot of brokers on over the years. Super excited to get some time in today with a group of brokers. Before we do that, want to let you know, as we always do, that we are in a world where anything we say today is not legal advice or brokerage advice. It's general information for your educational purposes. Holmquist and Gardiner, founded in 2008. We do real estate, business law, and estate planning, on the taxable estate work, estate administration, things of that nature. Thanks for joining us. We are super excited to have some legends in the industry with us today, covering a wide range. Sean Tufts is a retail broker, been in the industry about 19 years, if my math is correct. Long time. Actually, everybody that is with us today is a Seattle native, so it's not like a come out of nowhere. We've all grown up around here and have had the opportunity to work together. Similarly, David Cahill, been a broker, I think it's been 18 years in the industrial and warehouse sector, and he is at JLL. Ben Garrett, office. Kidder Matthews, a lot of office leasing, both sides of the table, and a lot of experience. And I want to take the opportunity to just say that in the world of commercial brokers, there is a wide array, and there's definitely folks that you work with and go, okay, you know, that was an experience. And then there are those that leave a really positive vibe and feeling of value add. And the three of these guys for the last 16 years of my practice have been on that side of the equation where it's just been really positive and they really know their sector. So super happy to have them on today. We're going to have a discussion oriented 20-25 minutes of just an update on what's going on in their sectors and trends that they see. If you have questions, of course, feel free to ask them in the chat. We'll try to keep this short and sweet and have some Q&A at the end. Contact information for everybody is right here, and we'll show this again at the end. Of course, this is being recorded so that you can share this with your friends, colleagues, or family, and relate back to it if there's anything in here that is content that you want to look at again. With that, I think we'll just tee it up with Ben Garrett to walk us through sort of what's going on in the office sector. And appreciate you joining us, Ben.
Hey, Imants, thanks for having me. Hey, everyone, my name's Ben Garrett. I've been an office broker at Kidder Matthews for the past 17 years. My business is focused on representing office tenants in all things related to their facilities, site selection, renewals, relocations, subleasing, and specifically I work Seattle's office market, which is from, let's call it SoDo in the south through the downtown core, spanning up to Northgate. So what's been going on in my market? Well, if it was February 2020, I would tell you that things are freaking booming. But 3 years later, I can tell you that things are definitely not booming. What happened? Well, obviously, COVID and work from home happened, and that's had enormous impacts on the office market. So I remember the first time I heard WFH, someone texted me in early March 2020, "Are you WFH today?" I thought, what the hell does that mean? If only I knew. The first couple of years were new and confusing, and office tenants, companies didn't really know what to do. So they didn't do much. The market was kind of stagnant. There was very little movement, but the last 12 months or so, it's become clear what the future holds, and some companies are better positioned to make longer term decisions. So I'll touch on some of the trends we're seeing right now. You know, people go 3 years without going to work and their habits change. I totally get it. Work from home coupled with a very employee-friendly labor market definitely has made made a lot of executives hesitant and in some cases even scared to call people back to work. So now the economy's shifting, people are starting to come back, and there have been some big announcements lately with Weyerhaeuser, Amazon, DocuSign, Redfin, just in the past few months. And that's great news for downtown Seattle. People are coming back, but it's still a long cry from pre-pandemic days. So specifically, we're seeing employees come back en masse on Tuesdays, Wednesdays, and Thursdays. Mondays and Fridays are really slow, though. I read something the other day where the CEO of Ornado Realty Trust, which is one of the world's largest office landlords, he said something like, Friday's dead and Monday has 2 feet out the door, 1 foot out the door. So I totally agree. I mean, our parking garage in my building in 2 Union Square is packed Tuesday, Wednesday, Thursday. I mean, it's crickets on Fridays. They even are running a parking special on Fridays for $15 all day, which they've never done before. So the market, my market has about 105 million square feet of office space. And in early 2020, the vacancy rate was 4 or 5%. It's currently around 20%. We expect it to keep climbing. Rental rates are slowly dropping, and we expect them to continue to do so over time. There's kind of a bit of a caveat there. Some buildings are holding up a lot better than others, and some are really struggling and might even become obsolete in the next few years. So overall, as far as tenant demand goes, there's very little demand for office space in Seattle. Historically, at any given time, maybe 2 or 3 dozen requirements would be out in the market that are 20,000 square feet or greater. And right now, I mean, they're just a handful. Lethargic is probably the appropriate description for our market. There's a historically high amount of subleases right now. Cue the sublease piece, Imants, there it is. So you can see overall, there's about 5 million square feet of sublease space on the market. A lot of companies, you know, that just aren't using their space figure, let's reduce our occupancy costs, put it on the market. So they do that, but that doesn't mean it's going to get subleased. You have to significantly discount your space to make it attractive to subtenants. And there's just not a lot of demand. I tell clients when we're subleasing space, like, hey, if there's nobody on the dance floor, then we're not going to be able to dance with anybody. So you'll see the bottom right, there's a list of the largest subleases available in Seattle right now. And a lot of these are big tech companies. Over the past decade, I mean, tech has just totally dominated office leasing in Seattle. So having very little tech demand right now is having huge impacts on us. So what are companies doing that have upcoming lease expirations? Well, they're evaluating their size needs. And, you know, there's no silver bullet to this. Every company's different, but by and large, on a macro level, we're probably seeing, you know, reduction in office footprints. Maybe it's had to put a figure on it, 20 or 30%. Another trend to note is the notion of flight to quality. Some tenants in Class B or C buildings are, you know, faced with an opportunity to upgrade their space, move to better buildings at much cheaper rental rates. And oftentimes that's done by taking a significantly discounted sublease. Companies are looking for what we call commute-worthy real estate. It's well located. It has a ton of amenities. It's an inspiring place. And it kind of pulls their employees back to the office versus pulling them back to uninspiring office spaces. It's a funky time. I mean, I have an example, for instance, of a client that had 200 Seattle employees, and they still do. And they had 40,000 square feet of space. And in 2021, their lease expired. They decided to get rid of 1 floor, so they went down to 20,000 square feet. And then in fall of 2022, they said, hey, we don't need any space anymore. Let's just go virtual. So they're hanging out. They're looking for that commute-worthy real estate. They want to pull people back to the office, and they're looking for 5 or 10,000 square feet of space, just a communal gathering space that people are going to want to come and hang out at. It's just a strange time. 10 years ago, you know, a 200 employee firm, of course, they would have a ton of office space. Another trend we're seeing that's totally hindering leasing activity is tenant improvement construction costs. Kind of like everything else in our lives, it's probably double the cost to build out space now than it was 5 years ago. Landlords need to spend a ton of money to spruce up dated spaces, and in some cases, they just won't do that. So a lot of space out there, I mean, not a lot, but some, is kind of becoming obsolete. Like, it's unleasable at this point. All these trends combined, you know, vacancy increasing, demand decreasing, run rates decreasing, operating expenses are going up. Even brokerage commissions actually go up during recessions. So combined, I mean, it's becoming a really difficult time to be an office landlord. But what about opportunities in this market? If you're a tenant looking to sign a lease, you're stable, you can forecast out your headcount for a while. We are seeing deals out there that we haven't seen in 10 plus years. So what I do is just represent tenants, and for them, there's some good opportunities. It'll be favorable going forward. But sorry to kick this off on a somber note. That's the state of our office market, Imants. Thanks for having me.
Well,
and I'll let you take it from here.
Yeah, I figured we'd try to get some of this out. You know, the office sector is, you know, everyone's, I wouldn't say favorite talking point, but it's clear. It seems to me to be the clearest, you know, one to look at and be like, but But these are very good specifics, and I've got a few questions, but we'll circle back at the end. Ben, really appreciate your input on this, and
Absolutely.
this is good data. With that, let's bring David Cahill on, JLL Industrial Warehouse Leasing Guru Broker. If David, there we go. Well, let's see if we got David.
Here we go.
Awesome. Thanks for joining us, David.
Absolutely. Hi, everyone. Nice to meet you. David Cahill, Jones Lang LaSalle. I'm on the industrial team here. We've got 6 members that basically focus on Seattle down through, well, now to the border, down through Vancouver, down to Oregon, and then a couple of gentlemen that focus up north. So at the heart of our market, the real industrial market it was port to port, Seattle to Tacoma. You have the Kent Valley, I-5, 167, natural freeways for distribution. And that was the market for quite some time. It's now, with the strength of industrial, made its way down south. Thurston County is a big part of our market. We see the market in the next 10 or so years connecting with Portland. Winlock has become a beachhead with Lowe's down there. Vancouver has got some Amazon leasing going on. So we're really seeing it to become one large market. A lot of that was driven by the insane population growth that the tech industry drove. And then, Ben mentioned work from home. Work from home isn't really an option for industrial. You can't be manufacturing or distributing from your house. You've got to be in the warehouse. You've got to be out on the roads. So that actually was kind of fuel to the fire on the industrial market. We saw insane growth in 2020 and 2021 and 2022. Still an incredibly healthy market today. We're not naive to what's happening out there in the economy and are just kind of going day by day, but we still have a very low vacancy rate. It's up in the mid to high 3s right now. A lot of that has to do with some new deliveries last year, or this last quarter, excuse me. But tenant demand remains strong, vacancy remains low, and rent growth is something that we still can't really put a cap on. It was up in the teens last couple of years. We expect it to continue to grow, hopefully at that rate, but understand that it may not as we get a handful of deliveries of new construction in the next couple of years. One thing we like to point to quite a bit are the asking rates. I mean, forever, I've been doing this for 15 years. Rental rates for probably a 20, 30-year window were between 30 and 40 cents a square foot for industrial in the Kent Valley. Today, rental rates are north of $1. You can see $1.06 there on the slide for blended rates. They really took off in 2020, 2021 on new construction. Another thing Ben mentioned is flight to quality. There's a few new developments that came out of the ground, and with keys being insurance provisions, ESFR, nicer offices, amenities for even warehouse tenants, new construction has really gotten a lot of attention. And with that, been able to push rents substantially throughout Seattle all the way down through Thurston County. Some of the factors that have led to this are onshoring, supply chain. We all remember 2020 when there were supply chain issues and you couldn't get anything. You'd order a TV, you'd order a fridge, you'd order whatever it might be, and it was always, you'd see on the news supply chain issues. Well, a lot of that has to do with most of our products come from overseas, come from China. To mitigate that, we have begun having US-based companies or companies in the US bringing more product on site, 10 to 15% additional product to offset any potential delays in the supply chain. So you just add 10 to 15% of each requirement, that's going to really eat up the vacancy in every respective market. So leasing velocity, tenants, rents have all remained very, very healthy and continue to look positive going forward. We've seen a hiccup on the capital market side. There was a few good trades at the end of last year that went us in the right direction. Peak in 21, cap rates got down sub 3, which is, there's just very slim margins at that point. You can't go much lower than a mid 3 cap rate. We're kind of settling in the 4 range now. There's one project under contract right now in Lacey, an Amazon-backed short Walt on that deal, about 3.5 years. And Walt is weighted lease average. That's how quick a landlord can get up to market rents. So deals that were signed 5 years ago, anyone that buys that, they want to jump that rate up as fast as they can. So the shorter the Walt, the better. And this one in Lacey is roughly a mid to low 4 cap new construction asset, and that is going to be a great data point if once that closes. That's going to help us going forward here. There's a lot of these institutions that own product up here. We're an institutionally dominated market, and these groups own office, they own retail, they own multifamily, and they own industrial. And if there's redemption queues coming, it's they don't want to sell industrial, but it will sell, and it will sell for a good number. And that's why we're going to see some products spit out here in the next few quarters. There's some slides up there. Imants just put up there on just general stats. You can see those asking rates. What's interesting about the asking rates is in 2021, the first big new deal done after all the uncertainty of COVID was 84 cents square foot on the shell. And then within 12 months, the next deal done in that size range was $1.20. So rents just skyrocketed, and they continue to skyrocket. That's an average asking rent. So that includes Class B, Class C, and new construction. We kind of tier out our rates. The market goes from Seattle all the way south. So South Seattle, you're roughly in the $1.65 range. When you get down to Kent, you're in the $1.15, $1.20 range, about $1 in Pierce County, and then high 90s south of that. So there is savings the further south you go. If you're filling the King County, the East Pierce County market, you want to be in that Sumner North market where you've got I-5 and 167 right there at your disposal to get up north or south. Good, strong development pipeline. A lot of the development today is happening out in an area called Frederickson, just available land and land that is zoned properly. You can develop industrial. If you are going to find land in South Seattle or Kent, there is the potential there, but a lot of it has hair. It's either contaminated, dirty site, got to work through that, or you're accumulating multiple parcels owned by individuals just to try to get yourself 8 to 10 acres to build a couple 100,000 square feet if possible. So land's hard to come by. We're a land constrained market. If everyone on this call is local, we've got water to the west, mountains to the east. So it's tough to find land. We're not like markets down in the IE or Phoenix or Reno, where a lot of flat land. You can just keep building. That land constrained market has been a benefit to institutional owners because it's tough to penetrate this market, and our development will go south, it will not go east. So to be able to satisfy the larger population, you want to be as close as possible, and there's just limited land opportunities. That's also been a big factor in our vacancy rate, in our asking rates, and our price per land, and so on and so forth. Manufacturing has been really on the rise, mostly advanced manufacturing. Blue Origin obviously planted a big flag here, and Boeing is continuing to grow. They've got quite a big presence up here, as everyone's aware of, but it's been Blue Origin, Stoke Aerospace, and groups that are in that advanced stage whether it's space exploration, whether it's trying to power generation, battery manufacturing. Those are all factors that have become very popular in our market and pulling off of the let's say intellectual capital that the Amazons, the Blue Origins, the Boeings of the world have placed in our market. There's a lot of very smart people up here, and they're spawning companies out of these bigger, larger groups and starting up here and staying close to market, and that's been a big factor recently. This is just a good indication of how we fall in line with, we're not overbuilding, we can't overbuild against the factors I mentioned earlier, but we're about 4.6% of our overall market is under construction, and a lot of that is so far out in Frederickson that it just puts a higher premium on close-in markets. When times get challenging, we tell our clients, if you're going to stretch port to port, right? There's the first areas that usually have I don't want to say suffering, but challenges would be farther out tertiary markets, and before those markets were kind of down by the Port of Tacoma, a little further east, areas like Lakewood, but today those are considered core. So we're right in line with where we need to be as a market to remain healthy and sought after. Q2, you can see quite a bit coming next quarter. That's been a real big factor in our rent growth rate is limited opportunities. This quarter, or I guess previous quarter, if you wanted 250,000 square feet of new construction, which is I'm not going to say a large deal in our market, but a good size deal, there was only one option available. A handful are delivering next quarter, or this quarter, excuse me. But even those are spoken for or have proposals on and are already competitive. So we don't expect a lot to happen in terms of rent reduction. Part of this also is when you're 97% occupied as a market and you're institutionally dominated, these groups can take on vacancy for 1 or 2 quarters. They're not going to suffer. They're going to wait for the right deal. And as such, they're not going to lower their rate. There's been no fire sales. Hasn't had to be. And this is in line with our asking rates. You can see we're one of the higher priced markets, which is not a surprise for large institutional companies. They're usually have a flag planted in the IE over on the East Coast of New Jersey and in Seattle. So it's not a shock to see a $1 a square foot rent in industrial. If it's a local mom and pop company that's coming off a 5-year lease where their rent when they expire is in the 60-cent range, and all of a sudden they get a proposal for $1.20, that's been a big shock. The challenge for those companies is they go out in the market to find a new home and they can't because it's 3.5% vacant, and there's a lot of tenants out there looking for that type of product. So it's quite in favor of the landlords right now. The leasing volume, again, this is kind of repeating what I said earlier. It's been a strong leasing activity quarter over quarter, as you can see. A lot of these larger Q1 or 2021 and 2020 and 22 is when a lot of new product hit. That's been very helpful for our market. You can see here consumer products and construction materials. That's all been the kind of heartbeat of our market forever. We're not going to be a 1 million square foot market to distribute to multiple states. If you go onto the East Coast or you go down south to California or parts of Arizona, you can hit a lot of the population in a one-day drive, which is a big deal for distribution users. We really do focus on users that are going to be hitting the Pacific Northwest, parts of Oregon, parts of Northern California. Is where the heartbeat is. Just a little anecdote on some of the deals that were done this year. You can see negative absorption. That has to do with a couple move outs and then new deliveries, but healthy market. Tesla went up north, which is a big get for that Marysville market. That's a new venture up there. The city is very in favor of industrial, which is great. Doesn't always happen. And it's along I-5, which is a big driver for industrial users. As you can see, Boeing has been active. Harbor Freight was in our market for quite some time. They ended up leasing space from an area called Fred 310, which is 310 acres of land in Frederickson that Boeing sold in 21 to Pro Partners and Panattoni.
Awesome. Thank you, David. That's super helpful and insightful as always. I think we'll do the Q&A at the end just to tie it all together. And with that, we move over to Sean Tufts. Ben and David focused primarily in leasing, and Sean is primarily in sales. I thought it'd be good to get a sales perspective. Sean does a lot of retail sales sites, and tell us a little bit about what's going on in that market.
Sure. Thanks for having us. Again, we don't do any leasing in our marketplace, so can't speak to kind of vacancy rates and overall, absorption. I will say for the last 15 years, retail has been kind of an afterthought, especially to multifamily and office. I think we're now finally getting calls from folks that have not had any appetite for retail and coming to the table thinking that now is actually a pretty good time to diversify, or there's less maybe wounds out there in the retail space or some more opportunities. So it's an interesting time to be. Every 5 years we hear that retail's dead, whether it's e-commerce or work from home or otherwise. I think the pandemic taught us one thing: it's that folks do not want to stay in their house and just order in all the time. That's a great supplement, but people want to be out and spending money. The difference between all those other asset classes and retail has been just a lack of new construction. Very little. In fact, in the Puget Sound, we've had net new construction over the last 5 years. Deals like Northgate Mall that have been torn down, go for a variety of mixed use, including, bringing in the crack and practice arena that just took a bunch of square footage off the table. So for every vacancy that's out there, you hear all the negative news about big box and all these, legacy tenants, the Sears and Kmart's of the world that are no longer even Bed Bath now. But for every Bed Bath and Beyond that we're seeing come vacant, the landlords of those spaces have, 3 to 5 national tenants that'll take it kind of as is and compete for that space. So a little different narrative than maybe what the national news is telling you, especially here in the Northwest, as we just have not built any sort of retail outside of, some smaller single tenant or ground floor retail as a part of a, forced mixed use vertical development. Retail health for just overall has remained incredibly strong. Obviously pumping a bunch of money into the system over the last couple of years. People have spent that. I think we're starting to kind of see the end of those days. Home Depot now today announcing their first negative year-over-year sales for the first time since 2009. So although it's been very healthy and these retailers need to expand and grow, I think there is starting to, something to keep an eye on. We can go to the sales volume here. You will see on the next slide. Obviously, the last handful of years, this is all retail in the Northwest sales. There's a couple of key kind of components that have, swung the needle quite a bit. Obviously, when 2009, before the Washington State excise tax increase, there was a ton of product pushed through. Then we were hit by COVID thereafter, and now we're kind of falling down the wayside. Q2, I think, although we're not done with Q2 by any means, we don't expect that to move up tremendously. We're in a place now where interest rates have finally taken effect. The overall kind of 1031 volume out in the marketplace is probably down 80–85%. And what that's doing is just, causing a lot of people to stall out. The deals that have been built on the new construction standpoint, there are a handful of developers that are meeting the market and need to execute. There's also a lot of folks that don't need to do it or can't afford to sell at today's cap rates. I think what we're seeing here, now is that the deals that are trading, there's still some unicorn buyers out there, and those deals will, trade at low cap rates, but that's not, the reality of the marketplace. We're still just in this kind of price discovery, and we'll need some time as we settle in here to what we believe to be kind of the next new normal as it relates to interest rates and where debt is for, retail investment sales here in the Northwest. Moving on here. Everybody always wants to know about cap rates. Historically, we were around a 6% cap rate over the last 10 years. The free money finally did catch up to us and things got hyper competitive, especially in the single tenant, arena that's been driven primarily by, folks selling either land for development out of California, selling farmland, or selling, selling manufactured housing or other product that, multifamily that they could sell at a 2 cap and come up and buy a 4 or 4.5 cap with some cheap debt in place. Those days are gone. Obviously, we're settling in to what we believe, isn't, the heyday of we're not going back to where we were, but we're going to kind of settle in here, we think, to more historical norms. So although pricing is going to be a shock for a lot of people here over the next, 6 to 9 months, I think it's just important to point out that, it is not as dire as we think it is. It's kind of trending back to, the normal. And even with the 10-year dropping off a cliff here, this from the start of this year, at 3.5 today, we think we're just going to kind of settle into where deals will start transacting, and we'll have a reset in, kind of the historical cap rate range. Page here. Again, shadow and unanchored cap rates have had the kind of the steepest increase. They were in tremendous demand here for smaller strip centers or shadow anchored product. A lot of those were selling, down into the 5s or sub 5 even. Those days just didn't make a lot of sense, and now have seen, quite a sharp increase. A lot of the deals that are trading now are not the Class A product as well. So this is skewing towards, deals that need to sell. As it relates to kind of distress, we're yet to see any sort of distress out there in the market. We do think there will be some, lender driven or debt driven distress that happens, but that's mostly going to be from a larger scale of, institutional or REIT buyers or REIT sellers. And those going back to special servicing, nothing compared to what we expect to see, obviously, on Ben's side of the table with office and or even the multifamily market, where cap rates were so compressed and leverage was so extensive that trouble could be brewing in that regard. Last one here, just from a cap rate standpoint, is grocery anchored centers. Historically, there's been about 12 on average that trade in the Northwest, Washington, Oregon, Idaho every year. 2022 was a crazy amount, rebounded from COVID. Everybody, prices for groceries went crazy. Retailer health was tremendous. Debt for those assets was incredibly cheap. So I think there was something like 28 or 30 transactions that happened. Speaks to the overall volume and where people wanted to put their money. That has now fallen off a cliff. We don't expect there to be hardly any that do. The couple deals that have traded this year are, kind of class B, class C, secondary and tertiary markets. A lot of the product has traded that will trade, and we don't expect to see, many more grocery anchored centers trade until things, calm down, probably into the mid to late 2024. Next page here. Again, this just speaks to, I think, what we stated earlier. Multifamily caps have always hedged quite a bit below retail caps. With the rise in increase in interest rates, we have had a bit more wiggle room. A lot of the power center deals, we were trading in kind of the high sixes. They're now trading in the high sevens, and there's still, positive leverage in those deals. So it is bringing some folks out of the woodwork that we weren't used to hearing from, over the last boom cycle. And I think, this just speaks to, I believe, what, the market is calling for at this point. We're hopeful that this was the last Fed increase, knock on wood for all of us out there. Hopefully we get into a pause. And I think that, the 10 years speaking to that, where, again, we're not going to probably settle into something back of the free money days. Hopefully that we've learned our lesson from that overall, although it was fun and people made a lot of money, there's some serious pain that came out of that. And we'll hopefully get back to a new normal. And even if, rates are in the 5s or 6s for debt, then, we can all live with that. We just need time to adjust and, absorb into a new market with new comps and, realistic sellers and buyers out there. That's all I got for you.
Awesome, Sean. Thank you very much. So we have some questions. I'll get to those in a second. I'll just give my sort of overview here as an 8-person law firm and a 4-person transaction team that I had. We see a range of transactions across all of these sectors. Some that we didn't cover, multifamily, we're going to Q4 do a sort of a multifamily and multifamily financing webinar. But from my perspective, we have not seen the massive distressed sort of signals that we saw in 2008, where we had a lot of foreclosure work, a lot of lease workouts, and we're just not, that's not what we're seeing. We are seeing, some small signs, some, mechanics liens here and there. The overarching signal is just the deal volume is off. We're, more or less lawnmowers for our clients. So there's a lot of basic stuff. The loans are maturing. They need a refi. You may not like the rate, but we got to do the refi. So anything that isn't in the dirt, shovel ready and sort of moving forward with a construction loan, it sort of seems to be on pause for the most part. Multifamily development, particularly off. Of course, just the leasing, generally new deal volume is off, but anything that's like a renewal, people still need to, when you have your office space, you're going concern, and maybe you did some work from home, but you want to stay in that space. All that stuff is still happening. I would say a lot of this is driven just these interest rates for the deals from the deal side. And so there's still a swath coming through that are all ready to go, but it's just, okay, let's just wait and get the financing right. And so we anticipate a rebound, if that's a word we should use, as things sort of stabilize with what's going to happen with interest rates. And from my perspective, I've been downtown, 3 or 4 days a week, and the last few weeks with Amazon back, I'm speaking to the choir here, to the group that's here, but it's been amazing to see so many people back. And so I would think that's going to have an impact of some kind. So with that, just a few questions here. I guess one that jumps right back at the retail stuff that we just heard from Sean. what have the impacts been from e-commerce? I know it's a good question. Years ago, this was like the big threat to your sector. And I remember even being at some of your presentations, Sean, and people really concerned as Amazon stock, and sales volume grew. What are you seeing with regard to e-commerce and the effects of that lately?
Yeah, I mean, I think it's a good question. Obviously, something we talk a lot about. The percentage of sales continues to increase, but overall, so are our actual retail sales, bricks and mortar. And I think you've seen a lot of these online companies that existed only online are now, getting into the bricks and mortar space, feeling like they need to have a physical location. I think where, the end of the era of free shipping both ways is going to change things as well. You're starting to see a lot of companies, instead of giving back space and saying we were in 40,000 square feet, we only need to be in 20. They're finding other uses for that 20,000 square feet in the back. And so it becomes kind of a multi-purpose, physical footprint. And again, when you're trying to compete with an Amazon that can get product to the people quickly, you need to have, those distributions, not in 2 or 3 days away on a truck. You need to get it as close to as possible to folks. So although everybody viewed it as a threat, I mean, it's becoming more and more of a complement to bricks and mortar. And, we think that that's just trend is going to continue. And again, like I said, people like shopping. I mean, retail's been around, commerce has been around forever, for eons. And I don't think that's going away. I think we just haven't built as much of that product. So the bad retail is bad retail. It's going to be tough to solve, but they'll solve it in other ways, especially as you see kind of these industrial rents get up to some, that $1 a foot in our world at, 12 or 15 bucks a foot triple net is a big box rent in a lot of markets. So you can, there will be a balance there too for alternative uses for different spaces.
Awesome. On the office front, looks like question is, do you expect Seattle will have some office buildings become residential conversions? For Ben, obviously, and I've heard this question asked a lot too. So
yeah, that's kind of like the question du jour, or the hot topic right now. And it's really challenging to do an office to residential conversion for several reasons. I mean, from a very fundamental standpoint, just looking at the construction of most office buildings, especially ones that are 20, 30, 40-story glass buildings with 20,000 square foot floor plates. The plumbing doesn't work. The HVAC doesn't work. To have like an 800 square foot apartment, I mean, from the core to the window line, it would have to be like pencil shaped. So that's, I mean, one piece. That the small percentage of buildings that are viable candidates for that are older buildings, smaller floor plates, 6,000 square foot to 8,000 square foot floors. That are shallow, that have maybe like an L shape to them, that are not, big boxes. It could possibly be done there, but you have to look at the underwriting of all this. I mean, I've heard developers say if they got a piece of land for free right now, they couldn't make a project pencil given what interest rates are doing and where construction costs are. So, I don't know that you'd find a lot of lenders that would have an appetite for lending on a project like that right now anyways. So it's just, it sounds good. It sounds nice, but it's very, very unlikely to occur in mass. Maybe a couple buildings here and there. I can only think of one off the top of my head, or two where it's been done in Seattle, over the years. And that's the Cobb building, which was old crummy medical office building, is converted to really nice apartments done by Unico right across from Purple. But I mean, those floors are 6,000 or 7,000 square feet, and it's a 100-year-old building. And the other one's a Seaboard building at Westlake Center, 7,000, 8,000, 9,000 square foot triangular shaped building that's 100 years old, where it could be done. So it's just, unfortunately, it's not going to really solve our housing crunch problems, in my opinion.
yeah, interesting. Well, this whole concept is, I'm not going to say, I mean, it's kind of a never say never situation. I think there's going to be need for creativity. I don't know if that extends to that kind of infrastructural mayhem to an existing and totally designated purpose-built building. Another question, and maybe our last here, we are, and this is probably best for David, maybe, what are you seeing in terms of the impacts of the slowing growth of Amazon in the industrial and warehousing space? Is that having any impact or not so much?
Yeah, good. It's a good question. Not so much locally, nationally a little bit. It's kind of been twofold. One, they just couldn't expand here as fast as they could other places, right? We mentioned, land constrained area, land constrained market. They didn't really overreach here in the Pacific Northwest. In other areas, they did. They made plays on build-to-suits and they put a halt on a ton of projects. Where it benefited our market was there's a ton of spec development for every single other user out there, not named Amazon. And Amazon years ago went and bought up 70 or so % of all the roof trusses to construct a warehouse building. And that put a pinch on every developer nationwide. When they hit pause, that really freed up all those materials and allowed everyone to build a little quicker, right? And have a little more surety of getting a building up at a specific date. So Amazon hasn't really had a huge impact for us here locally. I think they've had 2 subleases, both on smaller footprint buildings, and have been really greenlit on everything else they've done here in our market. So while they've slowed, their presence up here hasn't really diminished much and had a large impact locally.
Awesome. Well, hey, with that, I'd like to thank all of our panelists for attending. Sean Tufts, David Cahill, Ben Garrett. Thanks, guys. Really appreciate you joining us, all our guests. This has been recorded. Again, you'll get a link to it if you didn't see all of this. And really appreciate you attending our webinar, and for you panelists taking your time out of your busy day to share with our group your insights. And if you have further questions, anyone can reach out. The contact information is here. Feel free. And thank you very much for joining.
Thank you.